Welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your stock-related questions tonight are Sanelisiwe Tofile from All Weather Capital and Devin Shutte from the Robert Group. Be sure to send your questions via email to stockwatch@bdtv.co.za, or you can SMS 41392. Sanelisiwe, Devin, good evening to you both. Sanelisiwe, if I may start with you, it wasn't a great start to the week for the all-share, down just about 1%. And it also seems that US markets are fairly tepid. And of course, it's a big week for them because there's quite a few major companies, those among the Magnificent Seven, coming out with results. Do you think we've hit a bit of a plateau, however, on markets at the moment?
Yeah, look, markets are tending to be quite volatile lately. I feel like I've been saying that for the past year, maybe even longer. A lot of the geopolitical issues, macroeconomic issues that have plagued the world have been seemingly driving markets. So I think the start of the year isn't all that different. There's still unknowns around where or when, I should say, rates are going to start coming lower. The Fed is due to make a decision later this week, and I don't think they're going to change much as yet. The geopolitical tensions around the world have escalated, now with the attacks from the weekend on these US facilities in the Middle East are also going to contribute to kind of heightened tensions. So I think markets are really braced for, one change, one side or the other. I'm not sure which side it falls, but it just seems like things are escalating at the moment.
Indeed. I mean, Devin, traditionally markets, if they were braced for some spectacular geopolitical fallout, say, would rush into so-called safe havens. Do you actually see that manifesting at all recently? Or are there too many factors for there to be any obvious trades?
There is a lot going on. I mean, you cast your mind back a year. We came into 2023. We were all, it was a certainty the US was going into recession and China was coming out of zero COVID and we're going to hit, big growth numbers, and the opposite happened to both. So, yeah, how things are going to play out is anyone's guess. But we do have, to your point, a few big drivers. The one's just been mentioned is rates and wars as well, and then you've got elections. So all that kind of put together really does bode for probably even more than usual volatile markets. But my sense is that rates, particularly out of the Fed and then the Bank of England and the like, will probably dictate a lot of market movements through the year.
Are you both particularly concerned about what's I suppose the tensions in the Middle East, and specifically the Houthi attacks in the Red Sea, and what the retaliation from the US, and what impact this might have on the oil price? Because do you think there's going to be some sort of distinct flare-up there that then could derail the interest rate cutting cycle that we're hoping to enter into, because it might have an inflationary impact and therefore would have this kind of ripple effect? Sanelisiwe, or do you think we should just maybe play it as it comes rather than perhaps bracing too far ahead, if you see what I'm saying?
Yeah, I mean, these things are notoriously hard to call. I'm no expert on geopolitics or really any kind of politics, so I don't know where this settles. I mean, the best thing, I think, as asset managers and fund managers is to try to position yourself in the way that you think is best to protect your portfolio from any kind of mess that might happen. I mean, you did see, as you mentioned, oil this morning was, the past couple of years, both trading days have been up on the back of some of these tensions. Gold has remained sort of above 2,000, again, on the back of these tensions, and has a safe haven appeal. So exposure to those kind of assets is probably good for your portfolio whilst there's still this uncertainty kind of lingering around. I think that's the best kind of view I can espouse on it. It's very difficult to call where these things go in terms of the politics.
Yeah, I know. Okay, so let's rather stick to the questions on actual companies where we don't maybe have to use so much crystal ball gazing. The one is on Mete. So your take on Mete at the current price of 14.74 Rand. Devin, if I start with you, they've got a new CEO, a permanent CEO under Paul Aflati, who's had quite an interesting career. I don't know if anyone remembers that he was a financial director at Eskom when Brian Darmus was the CEO. And then ArcelorMittal, which also quite a tricky company to get right. Your views on Mete, do you think this is an ignored stock by the markets?
Yes, I think it is ignored, but it has had its issues. I mean, it supplies into the automotive component parts. It has moved into energy storage, I think, which has definitely helped it there. But yeah, I mean, it's a tough part of the market, isn't it? If you just see the demand for automotives coming under increasing pressure, I think if you're supplying into that industry, really going to be tough. So, Paul's got his work cut out for him. He has that experience in difficult industries. But yeah, I think this is going to need some real discernible kind of macro tailwinds to see the share price turn around, and we just aren't seeing any of those yet.
Sanelisiwe, your view on Mete, because you've got the energy storage business, but then, I mean, do you think Mete is facing sort of an existential threat in terms of the OEM side of the business from electric vehicles? Is that a real problem for them?
I mean, that is one of the things that they have to kind of face with. I mean, they've got they call it a harness type of business, which basically supplies electrical wiring and cabling to automotives, in part, together with other parts. So as an example, that business might suffer from, a less complicated sort of electric vehicle with less parts to kind of configure and all of that. But at the same time, if they can reposition the business to actually benefit from EVs, could be something that they can do. But yeah, the pressure from Mete has been that, auto demand was somewhat lowered, on the back of the fear around, EVs coming into the market. And obviously affordability has been a big thing, especially in, I guess, South Africa, perhaps other places in the world as well. Inflation has just kind of made, big ticket purchases, not the kind of top of mind. So demand and all of those things has kind of come up for them. The energy business does kind of future-proof them, but obviously they have to get that right. And the only thing I think I would add to that is that at these levels, it does screen quite cheap. So for the investor who is willing to be patient, do the work as well to kind of really understand where the new kind of guidance is going to be from, or where the new direction is going to be from the new management, there could be something there because it does look quite attractive on a valuation basis.
Yeah. Okay. All right. Something to consider. What about Reinet? And we're talking about the Rupert family company that is their investment holding company. A viewer asks, any obvious reason as to why Reinet had a 2% drop today? I guess 2% is not catastrophic. I mean, that's, I guess, just a daily move. But Sanelisiwe, we're sticking with you. Your thoughts on Reinet and its underlying investments? Is this something that tempts you at all?
I mean, share prices move today is probably kind of, shouldn't be too worried about it in a one-day move, especially in a market that's also a bit wobbly. So you got to kind of look at it in that context. But I think, Reinet is got a good mix of assets. It's one that we like. Obviously, we sort of buy in and around what we think is kind of fair value or intrinsic value. I think it's probably moved to territory where we are holding. We're in a bit of a holding pattern right now because of because we look at where the share price is trading relative to the discount. And I think it's kind of looking a bit on the low side. So there's not a lot of margin of safety there when you're looking at that discount. There's a little kind of management fee that's attached to that business that makes it that discount kind of structurally wide. But for us right now, we holding on Reinet. We do like it, but we do think that it's got its kind of levels that we look at. But the underlying businesses are very good. I mean, BTI, Pension Corp, and a couple others. We think those are actually pretty good businesses.
Yeah. Devin, your thoughts there, because actually it's had a really interesting share price run over the last year. It's done really well. And a lot of people for a long time viewed Reinet as a proxy for British American Tobacco, which for a long time was its biggest single investment. And that's, the cash flows it used from that to make investments in other companies and also pay itself a really nice management fee, which is why a lot of people didn't like it for a very long time. But then it invested in Pence Corp, which is the British Pension Corporation company. Do you think think that trajectory that we've seen there, as far as the share price is concerned, tells you a lot about Pence Corp and very little about British American Tobacco, which has really struggled in the last year. And would you carry on buying it, actually, or would you hold it now, given the rally?
Look, I think it's a good summary. I mean, British American Tobacco did have a really tough previous 12 months, and Pence Corp the opposite. So I think when Pence Corp is probably half of the holdings now, attributed to that nice run up in the share price we saw from Renette. I think for us, Giulietta, when we look at these investment holding companies, we really want to get access to unique holdings that aren't listed. So in the private equity space, they do have a slug there. I think it's around 20% at the moment. But just if you want exposure to British American Tobacco or Pension Insurance Corp, take it directly. So not a slight on the assets as such, but we would want to see kind of more exciting unlisted assets for us to go in on.
Okay, and there's also some talk that maybe they've had an offer to buy their stake in Pence Corp, which would be quite interesting if they did sell it, because then what would they be left with? I mean, you talk about the other assets, the unlisted assets, which haven't been great performers. There were some Lehman Brothers funds, which I don't really know if they've ever done anything great for this company. Do you look at those quite closely? Sanelisiwe, you guys hold Renette. I mean, what do you make of the smaller assets within the company?
I mean, unless they become sort of a larger part of the NAV, I don't think they necessarily move the share price and the valuation, right? I mean, the largest part of the business now, I mean, I think Pension Corp has overtaken BTI as the largest part of the NAV. So those two businesses are the kind of the big ones in the mix. But as Devin says, I mean, if they do kind of find a way to grow that business, then it could be an exciting opportunity for investors who don't have access to those type of businesses. And if they find businesses that are actually giving our portfolios access to kind of new areas of growth and good returns, then we'd definitely be excited to kind of have a closer look at that.
Okay, let's move on to retailers. Devin, there was a question on Spar asking whether it's a buy at current levels. The viewer says they'll have a sales update soon. Woolies Food had good numbers, and Spar seems way undervalued at 111 Rand a share. Do you concur with that assessment?
I mean, I think I would be cautious on Spar at the moment. I think, while the performance in Ireland has been good, and cash generation across the group has been fine, I think there are a lot of missteps and reasons for caution. I mean, the disastrous SAP project implementation, you could say it's a once-off, but that definitely hurt them. Poland is still with its issues. And the business is quite geared at the moment. So, we think, although it may look cheap on face value, we think, particularly in food retail at the moment where the environment is pretty tough, I think you've got to go for retailers that have proven track history of success in this environment. And I would argue Spars has struggled a bit.
So Sanelisiwe, I mean, the viewer talks about the Woolworths food numbers being good, but were they actually that good? Optically maybe, or superficially rather, if you take into account the inflation rates within the business, you could argue that the actual growth in volumes was somewhat negative. So I don't know how you feel about the food sector generally.
Yeah, so the thing about us with regards to retailers, I think it's a bit of an interesting space right now. You have to really pick your positions. So you have to go for the kind of the quality name. So name that comes to mind is ShopRite. I mean, they seem to always execute very well. But it is a bit expensive at these levels. I think at a 22 times multiple. But with regards to your question on Woolworths, I think yes, you're right in saying the numbers might have looked optically good. There was a big sort of sizable inflation number in there, but the food business did still have positive volumes, if marginally so. The problem was the apparel business, obviously, the fashion, beauty, and home. Negative volume still coming through that business, so that business is still struggling. I think guys like Foschini and Truworths and the likes might be doing better in terms of the sort of the apparel. So I think Woolies is a bit of a mixed bag. But the thing about the retailers right now, they're all screened relatively attractive on valuation. And I think it's been a sector that's been quite unloved over the past year. I think the positioning in the sector is very low. Guys are probably not keen to be holding the guys. And I think the reactions you've seen from these trading updates, I mean, again, we mentioned Woolies and an update that was probably a bit soft, but the shares didn't fall in a heap. You had Truworths today, update was a miss on top line, but the share was up 1.5% or whatever the eventual number was. So guys have clearly stayed away from retailers, and I think you're seeing that in the share price reactions. So even though the guys are not producing the best numbers, the shares are still quite resilient. So I think it's an interesting space right now.
And just quickly, can I get your view on SPAR? Devin saying, you know, why buy a company with problems in a really tricky environment? I mean, the environment is problematic enough as it is. Would you also take the same view that SPAR is a bit just too risky, that it's got too much self-help to get through?
Yeah. I mean, with SPAR, I think its problems are obviously quite unique to SPAR. Devin mentioned the balance sheet, mentioned the issues around SAP. I would also add to that the issue around, their franchisees aren't the most happy right now. They aren't pleased with the center. So you find that, franchisees aren't actually all that loyal within the SPAR network. So that's why you're seeing SPAR not really performing all that well at the moment, and especially if you look at the impact the SAP project has had in KZN, which is a large part of the SPAR business. They've got a quite large franchisee sort of business there. That particularly impact the KZN, and there's a bit of I guess, an uproar from the franchisees there. So once they're able to kind of fix those relations, I think maybe you can make a case that you can start looking at SPAR again. But I think those issues are still very much to be worked on by the new management team. And that's the other thing, they've got new management now who has to deliver on a new strategy going forward. Yeah. So I think it's a good prudent time to kind of wait and see on SPAR.
You mentioned Truworths. Devin, what did you think of Truworths? The share price rallying today on what were very tepid numbers from the Truworths Africa business, but I guess Office, the UK business, carried them through, and it was up in UK in pound terms, and then up considerably in rand terms. So I guess, when your currency is collapsing, it pays off for you if your home currency is what you report in.
Yeah, it's nice to see a South African company, benefiting from an offshore foray for a change. I think those offshore revenues from Office were up around 15%. In pounds, in rand terms, it was over 30. So that was great because, exactly as you said, very, very tepid performance locally. I think overall the market maybe was a bit relieved that things weren't worse, and that on balance earnings were flat to slightly positive. That is good in what is a tricky environment. But again, my sense is that there's stronger players to look to in the market. You look at the likes of Mr. Price and how well their update recently was received, and I think you've really got to stick to the quality names in the retail space in South Africa at the moment.
Okay. Then a question on Sun International and Nedbank, and the viewer asks, can you ask your panel if we can expect a great report for Sun International and also Nedbank in their next report in March, April this year? Sanelisiwe, Sun International, do you think it's going to be a cracker number that they're going to produce?
So I think the hospitality space is one of the bright spots that we are kind of seeing in the market at the moment. I mean, the market caps are a bit small, so you're kind of drifting into a small cap space here. So you'll probably find that not a lot of managers will really go in there. But I think despite that, this space is experiencing a bit of a purple patch at the moment. Both local and international tourism is up in South Africa, especially in Cape Town. But I think generally across the country, guys are more willing to get out and about. You've seen numbers from just previous numbers from Sun International and other peers, guys like Spur and all the restaurant groups and all those guys, all producing quite good numbers, which shows that people are out and about, they're eating out, they're traveling. And obviously foreigners have come back into the country as well and starting to tour the country as well. So it's a really actually like a good space for these guys at the moment.
Yeah, indeed, which is welcome because we have so few of those. Devin, but if you look at the share price performance, Devin, it's sort of stabilized. It had quite a nice rally towards, I suppose, mid half of last year upwards. Now it seems to be in a fairly tight range. Is the market just waiting for the numbers, do you think, to come out before it makes a call on whether to push it further?
Possibly. I mean, I think you've got to cast your mind back to COVID and how absolutely decimated these companies were when they pretty much just had to close their doors, but still at these high cost bases. And I think, groups like Sun and Sun in particular did incredibly well at taking an axe to those costs and really getting lean and mean. And now you've seen the revenues come through. I mean, last year was the first full year we've had post-COVID. In 2022 we were still masking up in that. So I'd still view this as a bit of a recovery play there. And yeah, exactly. The tourism numbers have been incredibly robust, and that'll feed nicely into a business model like Sun International. So yeah, I'm positive on the sector, and I think there's possible still growth to come.
And having said that, maybe the pullback that we've seen recently as a result of that Peermint announcement. We weren't expecting them to make a bricks and mortar acquisition. We thought it might be more in the kind of the Sun Slots or the Sunbet side of the business. Is there a nervousness in the market that having got rid of a lot of debt and having finally been able to pay a dividend, they're just loading themselves up with debt again, and you just hope it doesn't go wrong? Is there an element of nervousness there, do you think, Sanelisiwe?
Look, there'll always be nervousness around acquisitions for companies. Investors, I think, will always, perhaps not always, but a lot of the time will prefer to get that return in their hands. And there's obviously always execution risk around acquisitions. So, it remains to be seen. You have to kind of see management strategy around the acquisition and see if they can actually execute and kind of bed that into the kind of existing business. We've seen a lot of businesses overreach, kind of roll up new businesses and not really bed those down into their existing operations and run into trouble because of that. And then to kind of show that this business will actually generate a higher return than, say, paying investors, whether through a dividend or a share buyback.
Yeah. Okay. And Devin, just very quickly, Nedbank, do you expect good things from them when they come out with numbers?
I'm not sure what the numbers are going to look like, but I think they're in a pretty good space. I think the Nedbank loan book is particularly exposed to the property sector, which has been a really, really tough place to be. My sense is that there's a few tailwinds starting to build there, particularly in the commercial space. So they could be a recipient or a beneficiary there. But in the environment where rates are coming down, that endowment effect is going to lessen for them. So, that will reduce profitability. So I think on balance, I am constructive on them. I don't feel the banks are stretched from a valuation perspective. And Nedbank has got a nice loan book that I think could benefit from the time ahead.
Yeah. Okay. I shall leave it there and get to your stock picks. Sanelisiwe, what takes your fancy this evening?
I mean, we've already talked about the guys at length, but I think retail is a good space to be in. So I have my pick as Shutte.
Okay.
In addition to the kind of stuff we talked about earlier, they've also got they're keen to buy back shares, so that always is a nice thing for investors. But yeah, the growth in sort of the UK, hopefully that continues. The kind of less than I expected sort of decline in Africa was always a welcome thing. And of course, I think the lack of love the sector has received from the investment community is probably going to kind of pique people's interest again. So I think Shutte is a good, I think retail in general, I suppose, is a good option.
Yeah. Okay. And Devin, how about you?
I'm going global. Last year, large cap US tech was the only game in town, but I think we could start to see that shift somewhat. So I'm going for the iShares MSCI Emerging Market ETF. I think that as we see global rates start to lower this year, we're not exactly sure on the timing of that. I think the hunt for yield and growth will resume. And I think in a tracker like this, you don't have to explicitly pick a specific region or country. You get a basket of high growth countries, although South Africa is included in there. We'll take it. But kind of 26% to China, 16% to Taiwan, 17% to India. So all geographies that I think we're going into an environment that could really benefit investors there.
Okay, gents, we'll leave it there. Thank you very much for your insight this evening. Nice to chat to you both. Sanelisiwe Tofile is from All Weather Capital and Devin Shutte is from the Robert Group. Up next, The Close. Stay with us.